Every once in a while, a single quiet decision inside a bank changes an entire market forever. Not with a press conference, not with a headline alert, but with a balance sheet move so large that, by the time the public notices, the outcome is already locked in. This is one of those moments, because while most investors were watching interest rates, inflation prints, and stock market volatility, the most powerful player in the silver market made a move that rewrites everything you thought you knew. JPMorgan Chase just flipped 750 million ounces of physical silver. Not paper contracts, not exchange-traded funds, not derivatives. Real metal, real bars, real vaults. And the price tag for this move was roughly $22 billion. That is not a trade. That is not a hedge. That is a strategic repositioning for a systemic event. To understand why this matters, you have to understand who JPMorgan has been in the silver market for the last 2 decades. For years, JPMorgan was widely known as the dominant short seller of silver. Whenever silver tried to break higher, massive paper sell orders would appear out of nowhere. Rallies would be crushed in minutes. Momentum would die instantly. Traders had a name for it. They called it the JPMorgan short. This was not a conspiracy theory. This was proven in court. In 2020, JPMorgan paid $920 million in fines for precious metals manipulation. That fine covered years of spoofing, false orders, and coordinated price suppression in gold and silver markets. And yet, even after paying the largest manipulation fine in financial history, they continued operating. Why? Because the game still worked. Paper silver still existed in massive excess. Physical demand could still be delayed. Delivery could still be avoided with cash settlements. Until it could not. Between June and October of 2025, JPMorgan quietly closed its entire paper short position. Roughly 200 million ounces of paper contracts were bought back. That alone was historic. But what happened next is what should make every investor stop and reread this sentence. They did not leave the market. They went all in. Over that same period, JPMorgan accumulated approximately 750 million ounces of physical silver. Let that sink in. That is nearly 1 full year of global mine production. That is more silver than most central banks hold in their strategic reserves. That is a position so large, it cannot be liquidated without moving the global price. And they bought it at prices that mainstream media claims are already too high. Which raises one simple question. Why would the bank that spent decades suppressing silver suddenly decide to own more silver than anyone else on Earth? The answer is simple and terrifying, because the math finally broke. Silver is not just a monetary metal. It is a critical industrial input. Solar panels, electric vehicles, data centers, medical devices, semiconductors, power grids. None of these work without silver. And unlike investment demand, industrial demand does not care about price corrections or market sentiment. Factories do not pause because CNBC turns bearish. Supply contracts are signed years in advance. Production lines do not stop. In 2025 alone, industrial demand consumed approximately 1.2 billion ounces of silver. Global mine supply came in around 835 million ounces. That is not a small gap. That is a structural deficit. And this was not the first year. It was the 6th year in a row where demand exceeded supply, which means something critical has been happening behind the scenes. Above-ground silver inventories have been drained year after year to fill the gap. Vaults that once looked full on paper are now quietly emptying. And when physical supply gets tight enough, paper promises stop working. This is where lease rates enter the story. In October 2025, silver lease rates spiked as high as 35%. That is not normal market behavior. Lease rates represent the cost to borrow physical metal. When they rise that fast, it means one thing. Nobody has silver. Banks were willing to pay enormous annualized rates just to temporarily hold metal for delivery obligations. This is what a breakdown looks like before the headlines catch up. At the same time, COMEX registered inventory collapsed to 15-year lows. Registered inventory is the silver actually available for delivery against futures contracts. And yet, open interest continued to rise, meaning for every single ounce of deliverable silver, there were more than 2 paper claims attached to it. That is not a market. That is musical chairs. And JPMorgan understood exactly how this ends. They also saw something else. While retail investors were buying exchange-traded funds and paper proxies, The United States Mint announced Silver Eagle shortages. Think about that. The United States Mint, with direct access to refiners and suppliers worldwide, could not source enough silver to meet retail coin demand. If the mint cannot get metal, paper holders will never see it. That is when JPMorgan made the final decision. Stop fighting the inevitable. Stop suppressing the price. Secure the physical supply before everyone else wakes up. 750 million ounces later, the message is clear. The game has changed. And this was only the beginning. To understand why JPMorgan's move signals a point of no return, we have to leave New York and travel to London, because that is where the global silver market quietly broke. On October 8th, 2025, a single order hit the London bullion market that should have been routine. 1,000 tons of silver, roughly 32 million ounces. In global commodity terms, that is large but not extreme. It is less than 4% of annual global mine production. It should have cleared without drama. Instead, the entire market froze. Liquidity vanished in minutes. Major trading desks pulled quotes, and silver lease rates exploded from near zero to as high as 200%. That is not volatility. That is panic. The London Bullion Market Association claimed at the time that their vaults held over 800 million ounces of silver. On paper, delivering 32 million ounces should have been easy. But here is the problem. Most of that silver was already spoken for. It was allocated to exchange-traded funds, leased to banks, rehypothecated across multiple balance sheets. The same bars were supporting multiple claims. So when a real buyer showed up demanding real metal, the illusion collapsed. Swiss refiner Metaller, one of the largest precious metals processors in the world, made a stunning announcement days later. They withdrew entirely from silver trading until January 2026. Think about that. A refiner that operates in 17 countries refused to touch the market because it could not secure feedstock without extreme risk. That is not normal. That is what a fractional reserve commodity market looks like when physical demand exposes the truth. JPMorgan was watching this in real time. They were not guessing. They were reading the order flow. They were tracking vault movements. They were seeing lease rates spike across every major hub. And they knew something else. The paper market could no longer absorb stress. COMEX registered inventory had already fallen to roughly 40 million ounces. That is, the silver actually available for delivery. Meanwhile, paper open interest represented more than 240% of that amount, meaning if even a minority of contract holders demanded physical delivery, the exchange would face a binary choice. Find metal at any price, or force cash settlement and expose the system. This is where commitment of traders' data becomes critical. In a single reporting week in 2025, commercial traders reduced net short positions by over 15,000 contracts. That represents nearly 80 million ounces of paper silver. Analysts expected a reduction of 5,000 at most. What happened was triple that. At the same time, managed money traders, hedge funds, and speculators went net short. This is an inversion. Historically, commercials short and speculators go long. Now, the entities with the most information are long, and the entities chasing momentum are short. That is not an accident. It is a signal. This is when JPMorgan executed the second phase of their plan. While closing paper shorts, they began accumulating physical at an aggressive pace. Warehouse receipts show consistent inflows, roughly 300,000 ounces per day over several weeks. This silver did not come from one source. It came from everywhere. COMEX vault transfers, exchange-traded fund redemptions, off-market deals with miners, private industrial holders willing to sell for a premium. This is what unlimited capital and global reach looks like. And while they were doing this, retail investors were told silver was overvalued. Here is the brutal truth. JPMorgan did not flip because they suddenly became bullish. They flipped because suppression became impossible. Paper only works when physical is available. Derivatives only work when delivery is avoidable. But industrial demand does not roll contracts. Solar manufacturers do not accept cash settlement. Electric vehicle factories do not hedge with futures. They need metal or production stops. And every ounce consumed by industry is gone forever. It is not coming back to the market. This is where the comparison to the Hunt brothers fails completely. The Hunts used leverage. They used debt. They used paper. JPMorgan used balance sheet capital to buy physical metal. There are no margin calls on bars sitting in a vault. There is no exchange rule that forces sale of privately owned inventory. There is no emergency lever short of national seizure powers. And more importantly, JPMorgan is not trying to corner the market. They are positioning for a supply failure that already exists. The Silver Institute confirms a structural deficit for the 6th consecutive year. Above-ground inventories are being drawn down faster each cycle. Recycling cannot keep up. New mines take a decade to develop. This is not a trade. This is a timeline. And the timeline is accelerating. January 2026 becomes the next pressure point. China's new export controls take effect. Silver exports can be restricted without warning. At the same time, large lease agreements come due. Thousands of tons must be returned or rolled at enormous cost. And when refiners return to market, they will either find metal or expose the shortage further. JPMorgan is not waiting to find out. They already made their move. And in the final chunk, we are going to break down the exact math behind silver's repricing, the price levels institutions are modeling, and why waiting for confirmation is the most expensive mistake retail investors make in every commodity reset. Now we get to the part of this story that JPMorgan's quantitative models already solved months ago. The part that does not care about opinions, headlines, or market narratives. The math. Silver's repricing is not a theory. It is a mathematical outcome of supply and demand that can no longer be deferred with paper. Start with supply. According to the Silver Institute, global mine production for 2025 was approximately 835 million ounces. That number sounds large until you compare it to what silver is actually being used for. Industrial demand alone consumed roughly 1.2 billion ounces in the same year. That is before investment demand, before coin minting, before central bank accumulation, which means the market ran a deficit of over 117 million ounces in a single year. And this was not an isolated event. It was the 6th consecutive year where demand exceeded supply. Every year before this one, the gap was filled by draining above-ground inventories. Vaults that looked full on paper were quietly emptying in reality. And now, those vaults are thin. This is where the COMEX becomes the breaking point. As of late 2025, registered silver inventory sat near 40 million ounces. Registered inventory is the metal actually available for delivery. At the same time, open interest represented more than 2.5 times that amount in paper claims. Which means if even 40% of contract holders stand for delivery, the exchange cannot fulfill its obligations. That is not volatility. That is insolvency. So what happens next? There are only two outcomes. Either price rises high enough to force cash settlement and ration demand, or the exchange admits it cannot deliver physical metal. Both lead to the same result. A rapid repricing of physical silver. This is where historical context matters. In 1980, silver reached $50 per ounce during the Hunt Brothers crisis. Adjusted for official inflation, that is roughly $185 today. Adjusted for real purchasing power using pre-1990s methodology, it is closer to $600. But here is the critical difference. In 1980, industrial demand was a fraction of today's levels. There were no solar panels, no electric vehicles, no data centers, no global electrification push. Today, industrial demand is structural and non-optional. Material science research shows that most industrial substitutes for silver only become viable at price levels between $2,000 and $4,000 per ounce. Below that, silver remains irreplaceable. This is what JPMorgan modeled. They did not buy 750 million ounces expecting a $10 move. They bought it because price must rise to the level required to destroy demand. That is how commodity shortages end, not with headlines, with price. Conservative institutional models point to $100 to $150 silver by late 2026. That is without a delivery failure. Moderate scenarios where cash settlement becomes common push silver toward $200 to $300. Extreme scenarios where paper trust breaks entirely push prices into the $400 to $600 range. At $100 silver, JPMorgan's position is worth $75 billion. At $200 silver, it is worth $150 billion. This is why $22 billion was deployed without hesitation. This is why zero short contracts remain. This is why the suppressor became the hoarder. And this is where the betrayal becomes clear. For years, retail investors were told silver was dead. that it was volatile, that it was not a serious asset. While that message was broadcast, physical silver was being accumulated quietly by the same institutions delivering the narrative. The $920 million fine was not punishment. It was a fee to suppress prices long enough to build the largest physical position in history. Now the accumulation phase is over. Now the signal has been sent. When the largest predator in the market switches sides, it is not a coincidence. It is a warning. Silver is already at new highs, and yet the smart money is still buying. Not because it is late, but because it is early in the physical repricing phase. The paper market is losing control. The physical market is taking over. And once that shift completes, there is no pullback big enough to save late buyers. The question is not whether silver reprices. The math guarantees that. The question is whether you recognize what 750 million ounces just told the world. Because by the time the headlines catch up, the metal will already be gone.